Imagine unlocking higher yields from real-world lending. Yields that traditional banks struggle to offer, all accessible 24/7 on the blockchain, with transparency and global reach that changes everything. What if private credit, the multi-trillion-dollar market powering businesses worldwide, finally moves on-chain in a big way? In 2026, that's not hype, it's happening right now. Welcome to the generational wealth community, your pathway from knowledge to legacy. We don't chase hype, we decode the market. Today we're diving deep into tokenized private credit and structured products, the next evolution in real-world assets that's quietly becoming one of the strongest narratives for sustainable real-world yield in crypto. This isn't about quick pumps. It's about bridging traditional finance's highest-yielding opportunities onto blockchain rails for efficiency, liquidity, and accessibility like never before. Let's start with the big picture. Private credit, lending to businesses, often mid-sized companies, or specialized financing like invoices or structured debt, has exploded in traditional finance because banks have pulled back, creating a massive gap. The global private credit market is already heading toward trillions, and tokenization is unlocking it on-chain. As of early 2026, the broader real-world asset tokenization space has surged past $20 billion in value, with private credit making up a dominant portion. Estimates put active on-chain private credit loans and originations well into the billions, often cited around $12 billion or more in key segments. This growth comes from real institutional demand for yields that beat the 4 to 5% from tokenized treasuries. Why is this trending so hard right now? First, regulatory tailwinds like the Genius Act and emerging clarity are making compliant on-chain credit viable. Institutions want higher returns in a low-yield world, and private credit delivers. We're seeing yields typically ranging from 8 to 12% on these tokenized loans, backed by real cash flows from businesses. Second, blockchain solves the pain points: illiquidity, slow settlement, high fees, and opacity in traditional private credit. Tokenization enables fractional ownership, 24/7 trading, automated compliance, and instant global access. Now, the key players building this out: Centrifuge stands out as infrastructure for on-chain credit funds, tokenizing everything from trade finance to structured credit. They've pushed past $1 billion in TVL recently, acting as an operating system for real business financing. With partnerships that bring institutional-grade assets on-chain, Maple Finance has evolved into a powerhouse for institutional borrowers, offering reputation-based lending without over-collateralization. Think efficient capital for professionals, backed by real-world balance sheets. They've captured a huge share of active loans in the space. Goldfinch focuses on under-collateralized credit for emerging markets and real businesses, spreading risk smartly while delivering those attractive yields. And don't overlook Ondo Finance, while they're leaders in tokenized treasuries with over $2 billion in TVL across products. They're expanding into broader yield and structured plays that tie into credit ecosystems. Structured products take this further. Think packaged on-chain derivatives or yield-bearing instruments built around private credit pools. We're seeing vaults, securitized tranches, and programmable notes that let investors slice risk and reward precisely. Platforms are curating these into DeFi wrappers, pulling in billions in TVL as institutions package real-world yield for on-chain use. Projections from firms like Pantera and others point to private credit at least doubling from late 2025 levels, with the overall tokenized RWA space potentially exploding as more funds and credit deals go live. What does this mean for you as an investor building generational wealth? This narrative shifts crypto from speculation to utility. You get exposure to real economic activity, business growth, invoice financing, diversified credit with blockchain's advantages, transparency via on-chain audits, faster liquidity than traditional funds, composability in DeFi for compounding yields. Risks exist, of course. Credit defaults can happen, though blockchain's verifiability makes them more predictable than opaque TradFi versions. Regulation is still evolving. Volatility in token prices doesn't always match protocol TVL growth. But the catalysts are strong. More institutional entries, maturing tech like zero knowledge for privacy and credit deals, and liquidity venues improving secondary trading. This could be the breakout use case for tokenization beyond treasuries. Private credit's structural growth meets blockchain's efficiency at the perfect time. If you're watching this, ask yourself, are you positioned for the shift where real-world yield becomes programmable and accessible to anyone? The data shows it's not if, but how fast. Subscribe for daily recaps, drop a comment on your biggest takeaway, and turn on notifications. We do a crypto news video every morning and a deep dive every afternoon. Let us know in the comments any subjects you'd like us to cover. Quick disclaimer, I'm not a licensed financial advisor. This is for educational purposes only and not financial or investment advice. Crypto is volatile. Never invest more than you can afford to lose. Do your own research.